Yeah. Okay. Let's share with you. Okay, so the transaction price is the amount of consideration to which an entity expect to entitle in exchange for transferring promised goods or service to a customer. So we don't provide any service or goods on free, right? We expect something. So that expectation should be returned. Otherwise, I sell something to you and I expect 1 million dirhams. You think it's worth only 100 dirhams. Got it. So it should be expressed also. And it excludes amounts collected on behalf of third parties, like any VAT amounts. So if there is a VAT in your sales, what will be your journal entry? Okay, for example, 1,000 dirhams is this sale you are going to do. So what will be the journal entry? How much is the VAT? Tell me the journal entry, complete journal entry. Okay. Okay. With the amounts, which places? Okay, cash account debited to how much? 1,050, right? Okay, then to output VAT sales is 1,050. And where does the sales tax goes? 50 dirhams into P&L or balance sheet? Where?
Goes to FTA.
Yeah, I will write the journal entry, so you should say that. Okay. Okay, so okay, fine. Cash account debtor 2,050 to sales tax, right? It's 50 and to sales. So now let me know, where does this go? Balance sheet. Where inside balance sheet? Current assets. Correct. Then here, this one? Sale tax.
This goes to the liability side.
This goes to your liability side, right? Balance sheet.
Liabilities.
And current liabilities, right? In liabilities, under current liabilities, correct?
Yes.
And this goes to your P&L.
Revenue side.
Income side. Revenue side, right? Okay. Got it. Now, why this we are not taking into P&L? Because this is not our sales. We are collecting on behalf of government. Clear? So that's why we said here, any payment we are collecting on behalf of anyone else, third parties, it will not come here. For example, you sold me something for 1,000 dirhams. For example, we assume that there is no tax. You give me 1,050 and said, okay, I'm taking something from you for 1,000 dirhams. 50 dirhams you paid to Mr. Rajesh, and you gave that money to me, or paid to Abdullah. So what I do is I collect 1,050 from you, but this 50 dirhams which I collected is not for me, which I have to pay to someone else. Clear? Yeah. Any consideration payable to the customer, such as coupons, credits, or vouchers, reduces the transaction price. Clear? For example, if you are giving a discount, 10% discount, so your sales should be only 900. Correct? All good for you? Yeah. To determine the transaction price, an entity should consider the effect of the time value of money, and the variable considerations. So here, which we discussed about, time value of money is what? For example, I sold something to you, and you are going to pay after 2 years. So here there is some financial part. I will consider as an interest from you. If, for example, you come as a cash buyer and he comes as a credit buyer, for you, I'm going to sell it for 50,000. For him, I'm going to sell it for 60,000. 50 and 60. So 10,000 is a higher price I'm charging to him. That is the financial part. Clear? So then, so the revenue recognized must reflect the price that a customer would have paid for the promised goods or service if the cash payment had been made when they were transferred to the customer. Okay. If you bought from me for cash, I would have sold it to you for 50,000. Thus, the transaction price is adjusted for the effect of the time value of money when the contract includes a significant financing component. So the 10,000 difference is the financing component. So for example, I sold to her for 50,000, I'm selling to you for 60,000, but maybe only 10 days credit. Okay, so here there is no time value of money happening, but still what I did is I charged him more. Here there is no financing part or significant financing component. I put more profit on him. Clear. If he is going to pay back in a longer period after 1 year or something, then we can say it is a financing part. Clear. Now, the following factors would be considered in assessing whether a contract includes a significant financing component. Okay. So, for example, we will take this example 50,000 to you and 60,000 to you. You don't know whether there is a significant financing component or not. Now, what we are going to do is we are going to check it. So, the difference between the cash selling price of the promised goods or service and the amount consideration to be received. So, there is a difference. Price difference is there. 10,000 is a difference. Now we will check the combined effect of the expected time between the payment and the delivery of the promised goods and services and the market interest rate. Now, when you check there, okay, I'm selling to you on same time, I am going to receive the goods on same time. So there is a difference in price, but there is no difference in time. So there is no financing part. If there is a difference in time, then it is a financing part. Clear? The transaction price should not be adjusted for the effect of the time value of money if the time between the payment and the delivery of the promised goods or service to the customer is 1 year or less. Usually we give 30 days credit, 60 days credit. And for example, I gave 365 days credit. Then still, I don't need to provide the time value of money. That means you don't need to do the discounted cash flow. Got it? Next. The customer paid in advance, the transfer of goods and services is at the discretion of the customer. For example, is a bill and hold contract in which the seller provides storage service for goods it's sold to the buyer. Okay. In that case also, we don't use time value of money. Can you know? Season. You have some. Yeah, okay. There. Next, the substantial amount of the compensation promised is variable, and its amount or timings vary with future circumstances that are not within the control of the entity or the customer. For example, concession in the form of sales-based royalty. Sales-based royalty comes when there is copyright books. So when I sell something to you, for example, I'm an author of a book. I sold the right to you. Now, on number of pieces you sell, I get a commission or I get a royalty. So in that case also, you are going to pay me after 3 months or 6 months or maybe after 5 years once you sell the goods. Here also there is you don't need to calculate the time value of money. Yeah. Interest income or expense is recognized using the effective interest method. It must be presented in the income statement separately from the revenue from contracts with customers. Clear? You should show the interest, for example, the amount which I sold, 50,000 and 60,000. The 10,000, what I should show as interest, not as sales. So 50,000 sales and 50,000 sales. Then at 10,000 as my interest income. Clear? We have an example on January 1st, year one, BIF company sold and transferred a machine to a customer for 583,200. That is payable on December 31st, year two. That means after 2 years, right? Then other customers pay 500,000 only. Upon delivery to of the same machine at contract inception, the cost of the machine to BIF is 400,000. So I purchased for 400,000. I sold, normally I sell it for 500,000, but for this particular customer who's taking 2 years credit, I'm selling to him for 583,200. So 83,200 is the financing part. Okay, because why it satisfied the difference 83,200 and the time period 2 years or there. Then BIF determined that the contract includes a significant financing component because of the difference between the consideration and the cash selling price. Okay. Now the contract includes an implicit interest rate of 8%. Okay. Now, because in the contract itself it is mentioned 8% interest. Otherwise, what would we do? No, we will take the market rate, right? To the calculation. Anyway, that is the interest rate, right? But we have to do the what we say amortization of the interest. On what basis we'll do? On what percentage we will do? When we studied the debentures or bonds, we discussed, right? If we no leases, when we discussed about leases, we said if the lessee knows what is the lease interest rate, he will discount on that basis. Otherwise, he will take the market interest rate. Same principle here also. Got it? Now, for example, when you do a sales, the journal entry will be 500,000 is your sale, right? Okay, so accounts receivable, account debtor, revenue 500,000, and your cost entry will be COGS 400,000 to machine inventory 400,000. So let me know, when you normally do a sale, do you record this entry, the second entry? Yeah. Normally, when you do the sale, you do the definitely you will do the first entry, right? Does you guys do the second entry? System is passing in your company. System passes, right? So yeah. So that's actually we call it as perpetual system of inventory. Okay. In perpetual system of inventory, what happens whenever the sales is recorded, at the same time the cost of goods sold is also recorded in the back end. If that is not in the system, we should do manually. And if you don't have this stuff, basically you will be following periodic inventory system. Then if you want to find out the inventory balance at any point of time in perpetual system, you can check the closing balance. You will see whatever the inventory, that is your current inventory. Just you do the physical count is to know if there is any theft or small differences there. In periodic system, you can't know what is the inventory unless you take the full stock. When you take the full count of the stock, then you will know what is the value of inventory. So that is what periodic system. I think we discussed in the initial chapters about inventories. Okay, we discussed that. Just as a revision. Okay. Now, so you did your sales entry, and on December 31st, first year, what you are going to do? What is your sales? Receivables is 500,000, right? 500,000 8% is the interest. That is 40,000 is your interest income. You're passing your journal entry for that. Okay. And in next year, what happens? This 500 plus 40,000. So 540,000 is your accounts receivable. On that amount, you will calculate your interest of 8%. Clear? And after 2 years, your customer pay you. So your entry will be cash account up to accounts receivable. All good? Haifa? Next one. Are you happy with entry? Significant financing component, yeah, advance payment. So if there is an advance payment you are receiving from your customer, how you are going to treat that? For example, here on January 1st, year one, IVA company received a payment of 100,000 for delivering a machine to a customer at the year end. End of year two, the cost of the machine is 70,000. IVA determined that the contract includes a significant financing component. A financing rate of 10% is an appropriate discount rate. What is your entries? Okay. So when you do, so you receive something in advance, right? You didn't perform your part. So whatever money you are collecting is a liability for you. So it's a contract liability, 100,000. Clear. And so for this 100,000, you have to charge it 10% interest because you are receiving this 100,000 and you are keeping with you, right? So your interest expense will be 10% of that amount. So it will add to your contract liability. So your contract liability will be 111,000. Clear? Okay. And next, and in second year, what happens? You're going to record your sales. Okay. Yeah, all this comes. How much will be your sales amount? You have to calculate the second year's interest also. That is interest expense according to contract liability, 11,000. Because 110,000 10%, 11,000 you will add to your contract liability. That is your sales revenue, 121,000. So when you do your sales entry, you have to pass your cost of goods sold entry. Okay, so you remove that particular machine from your inventory. Got it? Next. Variable consideration. If a contract includes a variable amount, an entity must estimate the consideration to which it will be entitled in exchange for the transferring the promised goods or service to a customer. For example, the contract price may vary because of the following: there is a refund due to right of return provided to the customers, sales incentives, prompt payment discounts, volume discounts, other uncertainties in contract price based on the occurrence or non-occurrence of the future events. Okay. Now, see, whenever we say variable consideration, when we sell, we always give customer the right to sale return, right? Sales return. So we have to consider that. Then sales incentives we give, like if you take 10 goods, 11th goods will be the free. Then prompt payment discounts you might get 2% discount. You might have seen this 2 by 10 net 30. That means normally you have 30 days credit. If you pay within 10 days, you will get a 2% discount. So that's called the prompt payment discounts. Clear? Then volume discounts, when you take more goods, you get discounts, more discounts. Next. Okay. Then the variable consideration is estimated using one of the following methods. That is the expected value, one method, and most likely amount. So expected value is the sum of probabilities, weighted amounts in the range of possible consideration amounts. This method may provide an appropriate estimate if an entity has many contracts with similar characteristics. We'll actually basically we will discuss expected value in another chapter in detail. That's a very big portion. Then the most likely amount is the single amount, most likely amount in a range of possible consideration amounts. This method may provide an appropriate estimate if the contract has only two possible outcomes. Examples: a contract construction entity either will receive a performance bonus for finishing construction on time or will not. Clear? For example, you ask me to construct a villa for you, and the contract value is 1 million. Okay, and you say if you complete within 6 months, you will get a 10% additional. So that is the variable portion. So whether I will get this 10% or not is depending upon the completion of the contract within 6 months. Got it? The estimated transaction price must be updated at the end of each reporting period. Then comes the constraint. The revenue from variable consideration is recognized only to the extent that it is probable that a significant reversal will not occur when the uncertainty associated with the variable consideration is subsequently resolved. Clear? Then comes the volume discount. A volume discount offered as an incentive to increase future sales requires the customer to purchase a specified quantity of goods or services to receive a discount. The discount may be applied prospectively on the additional goods purchased in the future or retrospectively on all goods purchased to date. Like sometimes when you have a wholesale contract or you are a dealer for any product, you might see this like in a particular year, if you purchase 5,000 quantity, you will get 10% discount. If you cross 5,000 quantities, you will get 20% discount. So now, how you are going to calculate this discount? What if you purchase 6,000 units? What is your discount amount? What if you couldn't complete 5,000 units? What will be your discount? Clear? Now, prospective volume discount that provides a material right to the customer is accounted for a separate performance obligation in the contract, and retrospective volume discounts are accounted for as variable considerations. The uncertainty of the contract price for current goods sold is based on the occurrence or non-occurrence of some future events. That is whether the customer completes a specified volume of percent purchase. Now we will see this example, so it will be more easy for you. Now, Banashka company manufactured wool coats. On October 1st, year one, Banashka entered into a 2-year contract with the customer to sell coats for 2,200 per unit. Okay. Based on the contract, if the customer purchased more than 3,000 coats over the contract period, the contract price per quote would be retrospectively reduced to 150. So whatever you have purchased for 200 also will become 150. Got it? That means they should give you some money back. So this we will account. Okay. Now, the retrospective volume discount is variable consideration. In a year one, the customer purchased with cash 100 quotes. The Bershka estimated that the customer purchase would not exceed 3,000 during the contract period. Thus, based on the most likely amount method, the contract price per quote was 200. So when I saw, for example, you are my customer, and our agreement is that $200 per quote, and you should purchase 3,000 quotes in 2 years. In the first year, you purchased only 1,000 quotes. So I'm expecting that, okay, if this year you purchased only 2,000 quotes, next year also you will purchase only 1,000. So you won't exceed 3,000. So what I do, I will consider your sales as normal 200 sales. So my entry will be cash account debtor 100 into like 200, that is 20,000 is my sales revenue. And my cost of goods sold, that is $80 is my purchase price, right? CAG is account debtor inventory goods. Next year, what happens? You purchase more goods. Okay. Now, in the winter, year 2 was colder than expected. The customer purchased an additional 2,200 quotes. Accordingly, Bershka estimated that the customer would purchase more than 3,000 quotes over the contract period. The price per quote, therefore, was retrospectively reduced to 150. Okay. So, what should be the total amount? That's 150 into 3,200. Because consent he already purchased, right? Already purchases 100 only. Okay. So 2,300 it will become, right? So 2,300 into 150 will be the rate. Clear? Now see, okay. The price per quote thereafter was retrospectively reduced to 150. So what will be your rate? So first you sold for 100 into 200. Okay. Then what happens next is 150. 2,300 should be your total sales. 345,000, right? It should be ideally your total sales till date. Okay, this is first year. This is first.
This is total for the 2 years.
Yes, plus plus 2. 1 plus 2, 2 years. Clear. So what should be your second year sales?
150 multiplied by 2,022.
Okay, yes. Because 20,000 already he paid, right? So now he have to pay is 325,000. Yeah, now. So sales revenue. So your sales will be cash on 2,200 units into 200. Okay, that's what you're going to collect. Got it? Because you don't know whether he will complete or not. You expect that he will complete 3,000 units. So you will recognize a revenue of only 3,000. What we say? Switch 325,000.
If you exceed the number, we will just define that.
No, even if yeah, we will adjust in the last purchase. Clear. So here this entry is constant. You know what is that?
Yeah.
Now then the difference what he paid is your contract liability. You're collecting in advance. Got it. Next, again in third year, what happens? Accordingly, they reach 3,200, 400 units. That is the last year, 1,100 units. Clear. Now it should be how much? 3,300, right? 3,400? 400 into 150. So this is for the full year. 1 plus 2 plus 3. Okay. Now your this year sales should be this minus this alone. Okay. Because this is including this 20,000, right? So 165 should be your sales revenue. Got it? And how much money you will collect from the other party?
Difference between.
Difference.
because
So
we already paid in advance.
yeah, he have already a contract liability of 115,000 which he paid in advance. So balance 50,000 we will collect from him as cash. All good, Srijan?
Yeah.
Okay. Now, so identify the contract obligation we identified. Next, transaction price we calculated. Okay. Here we included this advance payment, say a significant financing component, variable consideration. We calculated the volume discount method, retrospective volume method. Clear. Next, we are going to allocate the transaction price to the performance obligation in the contract. Okay. Now, this is how where we have sometimes we have two products altogether. You're offering a single price for that. Okay, consolidated price for two products together. Now we have to allocate the transaction price of each product. Okay. Now, after separate performance obligations are identified and the total transaction price is determined, the transaction price is allocated to performance obligation on the basis of relative standalone selling price. Standalone selling price means I'm selling one laptop with a power bank, for example. This is an offer like 2,500. This is an offer price. So my question is, what if I sell this laptop alone? What is the price? It may be 1,900. So that is called the standalone price. If you are removing this combined offer, what will be the separate price of each of the product? That is the standalone selling price. So standalone selling price is the price at which an entity would sell a promised goods or service separately to a customer. Okay. Now, the best evidence of a standalone price is the observable price of a goods or service when it is sold separately in similar circumstance and to similar customer. Yeah. And we could say it as a list price of a goods or service. Then, if a standalone price is not directly observable, it must be estimated. The following are the suitable approaches. That is adjusted market assessment. An entity evaluates the market in which it sells goods or services and estimates the price that a customer in that market would be willing to pay for them. For example, the price of competitors for similar goods and services adjusted for the entity's cost and margins as estimated of standalone selling prices. For example, I am always selling my laptop with a power bank. So I don't know what is the separate price for selling price for laptop or power bank. So what I will do is for this particular specification, for example, this is HP. Dell is selling the same particular specification laptop for 1,900. So what I will take 1,900 as the price, plus I will adjust what is our cost. Maybe I am doing a lot of marketing. I have a different kind of colorful packing, so I have to add that cost. So I will adjust that price. That's called the adjusted market assessment. Clear? Next comes the expected cost plus an appropriate margin. So I don't know what is the selling price of this, but I know what is the cost of this. Definitely I will know, right? With this, I will put a margin like 10%, 15%. So that will be my new price or standalone price. So an entity forecasts its expected cost of satisfying a performance obligation and adds an appropriate margin for that cost. Clear? That residual and entity estimate the standalone selling price by reference to the total transaction price minus the sum of the observable standalone selling prices of other goods or service promised in the contract. Okay. So here I have a laptop, laptop and then power bank. For this power bank, I don't have any other comparison. No one else is selling this kind of power bank. So what will I do? And even I sometimes even I don't know the cost of this power bank also.
I will estimate the
Price of laptop minus from the total. Clear? That is the residual value. Got it? Yeah. Then the residual approach may be used only in limited circumstances. Okay. Because it is not accurate. If we don't have any other option, we will choose it. Then here. Allocation of a contract price. A company entered into a contract with a customer to sell a machine and provide 3 years of maintenance warranty service for it. The total consideration is 200,000. The company determined that the machine and the maintenance service are distinct performance obligation. Okay. The company regularly sells machines separately to a directly absorbed standalone selling price of 160,000. But it does not sell maintenance service on a standalone basis. Based on the expected cost plus an appropriate margin approach, the estimated standalone selling price for 3 years service maintenance is 90,000. Got it? So if you are selling service contracts separately, you might sell it for 90,000. If you are selling laptops separately, you might sell it for 160,000. So 160 plus 90, how much it became? 250. But you are going to sell this for 200,000. So what you are going to take is the ratio of this. Got it? Percentage. So that is 160 divided by 250, 250 multiplied by 160. So that is the cost of this particular machine. Got it? And for maintenance service, 90,000 is the standalone selling price. So that you multiply 90,000 divided by 250, you will get multiplied by 200,000. So what 72,000 is the cost in this particular contract. Got it? All good? Yeah. Right. Now we decide, we found out the customer, we found out what is our what is our obligation, we found out the transaction price, we found the, what do we say? What was that? I just forgot the word. Transaction price, when we allocated the transaction price, now we are going to recognize the revenue. Okay? Now, recognize revenue when a performance obligation is satisfied. An entity recognizes revenue when it satisfies a performance obligation by transferring a promised goods or service to a customer. Clear? Now, an asset is transferred when the customer obtains control of that asset. Clear? If I sell something to you, but still you don't have any control over that asset, then it's not a sale. Clear? Yeah. Control of an asset is transferred when the customer has the ability to direct the use of the asset and obtains substantially all of the remaining benefits from the asset. Clear? Like for example, you might have seen in YouTube and all, someone purchased a BMW car. It is having a lot of problem. He take the car to the ground, put petrol, and he put it on fire. He can do it because it is his property. BMW can't sue him, anyone can't sue him. Maybe there is like pollution or municipality can catch him, otherwise company can't do anything because he is the owner. Next. So that's what the has the ability to direct the use of the asset. I can do whatever I want in this. And how does the performance obligation satisfied? It can be either satisfied over time or on a point of time. Okay. For example, I have a contract with you guys to maintain your AC. It's a 1-year contract. So in that, what happens is every year, in every month, I will come and check your AC. If I want to change any, what we say, consumables, I will change. It's actually over the time. In 1 year, once the year completes, I will recognize full. Otherwise, I will recognize 1 month revenue, second month, third month, fourth month, monthly I will recognize because every month I need to show. Next one is at the point of time. For example, I have entered into a contract with you for the same air condition repair. And okay, this is a contract. Whenever there is a problem, I will come and fix. For fixing that, 2,000 dirhams or 5,000 dirhams. So if there is no complaint, I will not come. So I will not recognize any revenue. If I come there, I will recognize 5,000 dirhams revenue. Got it? So recognizing revenue over time because transfer of the control of goods or services to a customer over the time, and therefore satisfaction of a performance obligation over time. One of the following criteria must be met. One is the customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity performs. Clear? Got it? Then, for example, cleaning services are provided to a customer's office every day throughout the accounting period. Clear? The entity's performance creates creates or enhance an assets that the customer controls as the asset is created or enhanced. For example, a construction company erects a building on the customer's land. Clear? Here also, like you get progressive payments. You recognize revenue on the basis of completion. Revenue on the basis of completion. You might have studied concession contracts. No, I think you might have studied. Again, considering what happens, if it's a 10-story building, which I entered into an agreement, and I will say on the basis of completion, you should pay me. For example, I completed 5th floor till 5th floor. Now I will bring an engineer, or you might bring an engineer. He will certify how much percentage is complete. On that percentage, I will recognize my revenue. Got it? So that is what the entity performs. Entity's performance creates or enhance an asset that the customer controls as the asset is created or enhanced. For example, a construction company erects building on the customer's land. Asset created has no alternative use to the entity, and the entity has an enforceable right to pay for the performance completed to date. For example, an aerospace company contract to build a satellite designed for the unique needs of a specified customer. For example, I constructed or I manufactured some product on base 100% on your requirement. I can't sell this to anyone else. So I have an enforceable right. I will force you to make the payment. Yeah. Then an entity does not have an alternative use for an asset if that entity is restricted contractually or limited practically from directing the asset for another use. Sometimes what happens is, for example, there is a lot of custom-made satellites, aircraft, especially on defense. I might ask you to construct a defense aircraft on my architecture, on my what we say. I give you the drawing. On that basis, you are preparing. So you can't sell this to anyone else because patent is on my name. So whatever you considered, I have to pay you. Clear? No. Accounting for contracts in which revenue is recognized over time is described later on. Next, if a performance obligation is not satisfied over time, an entity satisfies the performance obligation at a point in time. Clear? So revenue is recognized at a point in time when the customer obtains control over the promised asset. The following indicators of the transfer of control should be considered. That is, the entity has a present right to payment for the asset. The customer has legal title to the asset. The entity has transferred physical possession of the assets. The customer has the significant risk and reward of ownership of the asset. Then the customer has accepted the asset. Yeah. This is what happens when you purchase dress, food, anything what you purchase. When they sell it to you, it's at point of time. And at that point, the sale is recorded. Clear? How does we show this in balance sheet? So a contract liability is recognized in the entity's obligation to transfer goods or service to a customer for which the entity has received consideration from the customer. Okay. Deposits and other advance payments by the customer, such as sales of gift certificates, are considered as contract liabilities. Like you might have seen in shops and all. When you pay 500 dirham, they will give you a gift card. You can give this to anyone else. And if that particular party doesn't redeem this card, what will happen? Okay, you gifted me 500 dirhams gift, and the gift card's validity is 6 months. Okay, you brought this card from his company. You gave me this card. If I use it, I will get some goods. What if I don't use it? I lost it. What will he do now? What should he do? He will wait till 6 months because the validity of the card is 6 months. After 6 months or 1 year, even I come, he will not give me anything. On the day the 6 month completes, he puts a journal entry and recognize this contract liability as revenue. Got it? Until that, it is a contract liability for him. When you purchase a gift card from him for 500 dirhams, his journal entry will be cash account debited to contract liability, bracket gift card. And after 6 months, he will reverse it like contract liability account debited to sales revenue, 500 dirhams. Now, a contract asset is recognized for an entity's right to consideration in exchange of goods or service that the entity has transferred to a customer. However, the entity must have an unconditional right to the consideration to recognize a receivable. The right to consideration is unconditional if only the passage of time is required before payment of that consideration is due. Yeah. Then contract assets and contract liabilities resulting from different contracts must not be presented net in the statement of financial position. Clear? Recognition of revenue over time. For example, for each performance obligation satisfied over time, an entity must recognize revenue over time. For this purpose, the entity measures the progress towards complete satisfaction using the output method or input method. Right. Here we will take the example of construction for building. So output method means on the basis of, for example, it's a 10-story building. I entered into a contract for 1 million dirhams. So 1 million dirhams is a selling price. If I completed 50% of the building, 50% of the building, then I will recognize 500,000 as my sales revenue. If I am following output method. If I am following input method, for this 1 million, the cost is like, for example, 800,000. So 800,000, 50% I have completed. That means 400,000. The 400,000 corresponding revenue I will recognize. Clear? We'll go same detail. So to determine the appropriate method, an entity must consider the nature of the goods or service that it promised to transfer to the customer. The chosen method should describe the entity's performance in transferring control of the promised assets to the customer. At the end of each reporting period, the progress towards complete satisfaction of the performance obligation must be remeasured and updated for any changes in the outcome of the performance obligation. Such changes must be accounted for prospectively as change in the accounting estimate. Like when you construct a 10-year or 10-story building or 20-story building, you won't complete in 1 year, right? It might take 2 years or 3 years. So every year you have to remeasure how much you have completed. For example, in the first year, you completed only 30%. So you will recognize the revenue for that 30%. Next year you completed 60%. That means you will you completed 70%. So 40% corresponding revenue you will recognize in the second year. Now, so now in input method. Input method recognizes revenue on the basis of the entity's input to the satisfaction of the performance obligation, 11 to, and the total expected input to the satisfaction of the performance obligation. Examples of the input includes cost incurred, labor hours expended, resources consumed, time elapsed, or machine hours used. And the long-term construction contract cost incurred relating to the total estimated cost often are used to measure the progress towards completion. This method is to cost method, formerly known as percentage of completion method. You might have heard this percentage of completion method. No? Little bit somewhere. Yeah. Okay. So now, only costs that contribute to progress in satisfying the performance obligation are used in the cost method. Thus, the following cost must not be included in the measuring the progress. For example, we entered into a contract to construct a house. For example, you gave me a contract to construct a villa for you. According to your plan, there should be 4 rooms. When I constructed, there is only 3 rooms. So what happened? You will come and say, okay, no, this is not according to my contract. So I had to break few walls. I have to reconstruct inside. So this additional cost, should I charge you? No. So that cost I should not charge to this particular contract also. and to the revenue also. Clear? The only costs that contribute to progress in satisfying the performance obligation are used in the cost to cost method. Thus, the following costs must not be included in the measuring the progress. That is, cost incurred that relating to significant inefficiencies in the entity's performance. That's what I say. Okay, like example, abnormal amounts of wastage materials or labor that were not chargeable to the customer under the contract. Clear? Then general and administrative costs not directly relating to the contract. Then selling and marketing cost. For example, I am constructing only one house, but I am advertising for 100 houses. I can't charge all the cost to this particular project. When an entity's input are incurred evenly over time, recognition of revenue on straight line basis may be appropriate. Clear? Here. Here an example for cost to cost method. And want a break? 1 minute break. Let's break. Huh? Yeah, okay. Small break. Feel free. If you want break, ask.